Ready?
Good, good.
The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Monetary Policy and the State of the Economy. I now recognize myself for 4 minutes to give an opening statement. I'd like to welcome back Chairman Powell. As I discussed earlier, and at our last hearing with you, I remain very concerned about the President's efforts to interfere with the Fed's independent monetary policy. A recent news story noted that Trump has tweeted over 100 times about the Fed since your nomination. Many of those tweets appear to be attempting to exercise pressure on the Fed. Chairman Powell, you and the Fed Board of Governors must not be swayed by these aggressive tactics. In upholding the Fed's independence, you should also be mindful of public perception. Of course, Trump continues to try to claim credit for economic growth that was put in motion by the policies of President Obama, congressional Democrats, and the Federal Reserve. His irresponsible trade war and the GOP tax scam have blown up the national debt, slowed our economic growth, and harmed hardworking American families. Trump continues to squander this inherited economy. Let me note that I am, however, disappointed in the Fed's efforts to deregulate mega banks, most recently by proposing to further roll back the Volcker Rule. The Dodd-Frank Act made our financial system safer, but it depends on agencies like the Fed to prudentially use the tools available to monitor and mitigate threats to our economy. The committee is carefully monitoring the developments in the repo market and the Fed's response. The Fed should not arbitrarily reduce liquidity requirements in response to the repo market disruption, as some on Wall Street have asked for. Instead, the Fed should make appropriate adjustments to promote a well-functioning repo market while ensuring we have strong capital rules that can't be gamed through window dressing, a practice where banks alter their balance sheet to appear less risky and reduce their capital levels. In addition, the riskiness of various financial assets is increasing as climate change poses a more serious risk to our economy. The Fed and other regulators should utilize financial stability tools under Dodd-Frank, such as incorporating climate-related losses into supervisory stress tests of big banks to address this growing risk. I would also like to discuss recent developments involving the Community Reinvestment Act, that is CRA. We've had a series of hearings on this issue, and I'm very concerned about OCC Comptroller Otting's harmful proposal to turn CRA into the Community Disinvestment Act and allow banks to escape their obligation to make responsible investments in the communities where they are chartered. I urge the Fed to take a careful, deliberate approach to any changes to the implementation of the CRA and to not join Comptroller Otting's misguided efforts. Governor Brainerd's statement, and I'll quote, "It's more important to get the reforms done right than to do them quickly," quote unquote, is absolutely correct. The OCC and FDIC should heed that advice as well and extend the public comment period as community banks, state regulators, community and civil rights groups, as well as committee Democrats have called for, so that all stakeholders have an opportunity to voice their concerns. I also encourage the Fed to keep a watchful eye on Facebook's efforts to launch a cryptocurrency and digital wallet, which, as we discussed at our last hearing, could have profound implications for monetary policy and compete with our own U.S. dollar. In light of the many risks Facebook's plans to create, I and other Democrats have called on Facebook to halt their plans until Congress can examine the issues associated with the big tech company developing these digital products and take action. I look forward to your testimony today, Chairman Howell, and discussing these matters. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes for an opening statement.
Thank you, Chairman Powell, for appearing before us once again. Under the Trump administration, we have the best economy that we've had in decades. The numbers are irrefutable. We added 225,000 new jobs in January, and the unemployment rate is essentially at its lowest level in half a century. This prosperity is being shared by all Americans, from African Americans and Hispanics, where their unemployment rate has reached record lows last year. The prime age labor force participation has reached 2.2 million people that were previously out of the workforce, and not surprisingly, consumer confidence has increased dramatically since the month before the president's election. Every member of Congress should celebrate these remarkable outcomes, which have resulted from Republican leadership on pro-growth policies like tax reform and regulatory right-sizing. But sustaining our economic prosperity also hinges on the Federal Reserve having good policy. The central bank is currently undertaking a review of its monetary policy framework to determine the tools it may need in the future. Chairman Powell, I raise the concern that we have regulatory policy that is impinging upon your capacity to make proper monetary policy. And that is why I think it's important that you have a regulatory review of the limitations that those regulations can put on your broader monetary policy decisions. That includes systemic risk concerns that I have raised, as well as the open market operations, well, especially the open market operations in the repo market. I thank you for your prompt response to my questions about the repo market operations, but I'm not sure there's been a satisfactory answer to what caused the market spike in the first place, and that's troubling. I've also voiced my concerns with the transition from the LIBOR reference rate. We have 9 months later, I'm still concerned consumers will be impacted by the transition. We still have contracts written to the LIBOR reference rate, and I think given the recent volatility in the repo markets, I'm concerned about the subsequent volatility in consumer-facing products, including mortgages, auto loans, business loans, and other consumer loans, as this new reference rate is derived from secured overnight financing. At previous hearings, I've spoken about the cyber threats posed to our financial institutions and your institution, and China in particular. Yesterday's news about the Equifax data breach is deeply troubling and is a wake-up call to every single policymaker that we need to take the threat of China and the Chinese Communist regime quite seriously. If we're not taking them seriously, have no fear, they are taking us very seriously. And now they have basically all of our data, too. So the spillover effects of this question of Chinese policy is significant, not just for cybersecurity, but what we're seeing with the coronavirus and the destabilizing effects it has on global health. I know you're not a global health expert, but you can give us some sense of your measurement techniques in response to these economic changes that are being driven out of the coronavirus challenge in China and the spillover effects it has to its neighbors and the supply chain as well that's derived through China. The nature of China's regime may not fit neatly into the Fed's risk assessments. The Fed has acknowledged in its financial stability report that cyber risks don't fit neatly either. But the risks are real. Even though our data is limited coming out of China, and the limited data we have, we question still, we should reflect appropriately upon what we know and how we respond as an American government and to the Western world in response to these threats, both cyber and health risks, and the spillover effect it has on our economy. So again, Chairman Powell, thank you for being here. Thank you for your openness. Thank you for your approach as Chair of the Federal Reserve to be in the language of the people rather than simply the language of the PhDs. With that, I yield back.
I now recognize the chair of the Subcommittee on National Security, International Development, and Monetary Policy, Mr. Cleaver, for 1 minute.
Thank you, Madam Chair. Mr. Chairman, first of all, I appreciate very much your willingness to travel around the country to do 14 of those Fed Listens sessions, and one of them you did in Kansas City at the Fed building. I think it's a rare opportunity for most people to get a chance to sit down in a room and discuss economics with the chairman. So thank you very much. When you came to Kansas City, people were sitting around the table with you and giving you a picture of their struggles and strives and trying to make it in the economy. People were concerned about inflation. They believe that it's like toothpaste. Once it gets out, it's hard to get back in. So we're concerned about but also appreciative of your work, and I look forward to getting a little further into this as we proceed with the hearing. Thank you, Madam Chair.
I now recognize the subcommittee ranking member, Mr. French Hill, for 1 minute.
Thank you, Madam Chair. Chair Powell, thank you for being here today. We appreciate your willingness to come and field our questions and provide your insights. I want to take just a moment and echo the comments of the ranking member on the Community Reinvestment Act. I know this has received a lot of attention. I read Governor Brainerd's very comprehensive views on the topic, and we had Mr. Otting here recently to discuss the OCC's point of view. As a former community banker, it's my view that we really should have ultimately one approach to CRA among the financial services regulatory agencies. I've had 40 years of dealing with inconsistency and delivery of regulatory proposals, and so I do think ultimately it would be productive for us to have one approach to that regulation and modernize it for the digital world that we live in today. I look forward to your presentation today, and Madam Chair, I yield back.
Thank you. I want to welcome to the committee our distinguished witness, Jerome Powell, Chairman of the Board of Governors of the Federal Reserve System. He has served on the Board of Governors since 2012 and as its chair since 2017. Mr. Powell has testified before the committee, and I believe he does not need any further introduction. Without objection, your written testimony will be made part of the record. Mr. Powell, you are now recognized to present your oral testimony.
Thank you very much. Chairwoman Waters, Ranking Member McHenry, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I strongly support the goals of maximum employment and price stability that Congress has set for monetary policy. Congress has given us an important degree of independence to pursue these goals based solely on data and objective analysis. This independence brings with it an obligation to explain clearly how we pursue our goals. Today, I will review the current economic situation before turning to monetary policy. The economic expansion is well into its 11th year, and it is the longest on record. Over the second half of last year, economic activity increased at a moderate pace, and the labor market strengthened further as the economy appeared resilient to the global headwinds that had intensified last summer. Inflation has been low and stable, but has continued to run below the FOMC's symmetric 2% objective. Job gains averaged 200,000 per month in the second half of last year, and an additional 225,000 jobs were added in January. The pace of job gains has remained above what is needed to provide jobs for new workers who enter the labor force, allowing the unemployment rate to move down further over the course of last year. The unemployment rate was 3.6% last month and has been near half-century lows for more than a year. Job openings remain plentiful. Employers are increasingly willing to hire workers with fewer skills and train them. As a result, the benefits of a strong labor market have become more widely shared. People who live in and work in low and middle income communities are finding new opportunities. Employment gains have been broad-based across all racial and ethnic groups and levels of education. Wages have been rising, particularly for lower-paying jobs. GDP rose at a moderate rate over the second half of last year. Growth in consumer spending moderated toward the end of the year, following earlier strong increases. But the fundamentals supporting household spending remained solid. Residential investment turned up in the second half, but business investment and exports were weak, largely reflecting sluggish growth abroad and trade developments. Those same factors weighed on activity at the nation's factories, whose output declined over the first half of 2019 and has been little changed on net since then. The February Monetary Policy Report discusses the recent weakness in manufacturing. Some of the uncertainties around trade have diminished recently, but risks to the outlook remain. In particular, we are closely monitoring the emergence of the coronavirus, which could lead to disruptions in China that spill over to the rest of the global economy. Inflation ran below the FOMC's symmetric 2% objective throughout 2019. Over the 12 months through December, overall inflation based on the price index for personal consumption expenditures was 1.6%. Core inflation, which excludes volatile food and energy prices, was also 1.6%. Over the next few months, we expect inflation to move up closer to 2%, as unusually low readings from early 2019 drop out of the 12-month calculation. The nation faces important longer-run challenges. Labor force participation by individuals in their prime working years is at its highest rate in more than a decade. However, it remains lower than in most other advanced economies, and there are troubling labor market disparities across racial and ethnic groups and across regions of the country. In addition, although it is encouraging that productivity growth, the main engine for raising wages and living standards over the longer term, has moved up recently, productivity gains have been subpar throughout this long economic expansion. Finding ways to boost labor force participation and productivity growth would benefit Americans and should remain a national priority. I will turn now to monetary policy. Over the second half of 2019, the FOMC shifted to a more accommodative stance of monetary policy to cushion the economy from weaker global growth and trade developments and to promote a faster return of inflation to our symmetric 2% objective. We lowered the federal funds target range at our July, September, and October meetings, bringing the current target range to 1.5 to 1.75%. At our subsequent meetings, with some uncertainties surrounding trade having diminished, and amid some signs that global growth may be stabilizing, the committee left the policy rate unchanged. The FOMC believes that the current stance of monetary policy will support continued economic growth, a strong labor market, and inflation returning to the committee's symmetric 2% objective. As long as incoming information about the economy remains broadly consistent with this outlook, the current stance of monetary policy will likely remain appropriate. Of course, policy is not on a preset course. If developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Taking a longer view, there has been a decline over the past quarter century in the level of interest rates consistent with stable prices and the economy operating at its full potential. This low interest rate environment may limit the ability of central banks to reduce policy interest rates enough to support the economy during a downturn. With this concern in mind, we have been conducting a review of our monetary policy strategy, tools, and communication practices. Public engagement is at the heart of this effort. Through our Fed Listens events, we've been hearing from representatives of consumer, labor, business, community, and other groups. The February Monetary Policy Report shares some of what we've learned. The insights we've gained from these events have informed our framework discussions, as reported in the minutes of our meetings. We will share our conclusions when we finish the review, likely around the middle of this year. The current low interest rate environment also means that it would be important for fiscal policy to help support the economy if it weakens. Putting the federal budget on a sustainable path when the economy is strong would help ensure that policymakers have the space to use fiscal policy to assist in stabilizing the economy during a downturn. A more sustainable federal budget could also support the economy's growth over the long term. Finally, I will briefly review our planned technical operations to implement monetary policy. The February Monetary Policy Report provides details of our operations to date. Last October, the FOMC announced a plan to purchase Treasury bills and conduct repo operations. These actions have been successful in providing an ample supply of reserves to the banking system and effective control of the federal funds rate. As our bill purchases continue to build reserves toward levels that maintain ample conditions, we intend to gradually transition away from the active use of repo operations. Also, as reserves reach durably ample levels, we intend to slow our purchases to a pace that will allow our balance sheet to grow in line with trend demand for our liabilities. All of these technical measures support the efficient and effective implementation of monetary policy. They are not intended to represent a change in the stance of monetary policy. As always, we stand ready to adjust the details of our technical operations as conditions warrant. Thank you. I look forward to
Thank you.
discussion.
I now recognize myself for 5 minutes for questions. In December 2019, when the OCC and FDIC issued a notice of proposed rulemaking on comptroller Auding's proposal, the Federal Reserve did not join this proposal. FDIC board member Martin Gruenberg voted against Comptroller Auding's proposal, describing it as, quote, a deeply misconceived proposal that would fundamentally undermine and weaken the Community Reinvestment Act, quote, unquote. And in remarks last month, Federal Reserve Board Governor Brainerd said that, quote, given that reforms to the CRA regulations are likely to set expectations for a few decades, it is more important to get the reforms done right than to do them quickly. That requires giving external stakeholders sufficient time and analysis to provide meaningful feedback on a range of options for modernizing the regulations, unquote. Chair Powell, Governor Brainerd also suggested in a speech last month that the Federal Reserve created a database of 6,000 public CRA evaluations looking at how various CRA investments support low and moderate income communities. Has the Fed used this database to evaluate how bank activities would be assessed under the OCC's and the FDIC's proposal for CRA?
If I understood your question, it was whether we've used our database to evaluate their proposal.
That's right.
I'm not totally sure we have. Maybe I can provide a little context, if that's appropriate, if I may, which is just that we do agree that this is a good time to update CRA in light of changing technology and demographics, and we agree on the goals. We put a lot of work into this. We tried hard to get on the same page and weren't able to do that. We have some different ideas.
Does the Fed intend to do this assessment?
Excuse me?
Do you intend to do the assessment that I referenced regarding the database to evaluate bank activities?
You know,
And how they would be assessed under the OCC's and FDIC's proposal for CRA?
Well, so the real point of that database was for us to create our own set of metrics. We want to be very, very sure that what comes out of this is a proposal that from us that will leave all major participants in CRA better off. And so we think it's important that each metric, each change that we make is grounded in data. And that was the purpose, was to help us develop our thinking and our proposals, and that's essentially what we've been using it for.
So given the magnitude of reform in CRA regulations, do you think the comment period should be extended to allow the public to weigh in on such an important undertaking?
That's really a decision for the OCC and the FDIC.
Well, I know it's a decision of his,
loath to
Mr. Powell, but
comment
what
on
do you
that.
think?
I think it's not our role to comment on their proposal. We have our own work and our own ideas that we'd be happy to share, but it's really up to them to make that decision.
So are you completing your assessment? Are you continuing to look until you come to a final decision?
We are.
Well, don't you think the public should have an opportunity to have more time to do that also?
And they will when the time comes. I mean, I think for the time being, what we're doing is we are looking forward to reading the comments on the proposal. I think we'll all learn quite a lot from those comments, and we'll be able to incorporate that thinking and whatever changes are made to the proposal. There may be substantial changes to the existing proposal coming out of the comments. So I think our view is that we want something that will leave everybody better off and will have broad support, and that's what we're going to be working on.
Well, as you may be aware, all of the Democrats on this committee urge regulators to provide a public comment period of at least 120 days on any major CRA reform instead of the 60 days that OCC and FDIC has provided. Community banks, state regulators, and community groups have called on these agencies to extend the comment period. And even though you said it is not your place to comment on whether or not that should be extended, I wish you would think about this, and I wish you would, as you are doing the assessment, and as you have said, it is important for the public to be able to comment, review what you are thinking, and if you change your mind, let us know about commenting on whether or not we should extend the comment period. You don't have to respond to that. Thank you very much. The gentleman from North Carolina, Ranking Member Mr. McHenry, is recognized for 5 minutes.
So it always is rich, right? So when somebody else has a negative comment about the Federal Reserve, that's bad. But when I, as a policymaker on the Hill, have a negative comment about the Fed, it's good, right? So it's all about the eye of the beholder when it comes to the political debate here in Washington. Congress made a decision over 100 years ago to outsource monetary policy to the Federal Reserve. You're a construct of law, you're given independent operations, and you have a set term of office. And so the independence of the Fed for monetary policy is appropriate and is longstanding. Every president in the last 100 years has had some private criticism, and we found out at some point about that criticism, either through press reports at the time or later, or some biographer's work about the president. But here on the Hill, we can make negative comments about the Fed and attack the president for having negative comments about the Fed, right? So all this stuff is just rich politics. Let's get down to the essence of this. You are the biggest regulator in town when it comes to the financial world. I have concerns that I want to address that are regulatory in nature that I think impinge upon monetary policy. The repo market, for instance. These operations you said are temporary in nature. Is that still true?
Yes, our expectation is that we will continue our bill purchases at least into the second quarter, and continue repo operations at least into April. And
into April.
The sense of that is, though, that we're building up a level of reserves to a level that will mean that we don't have to be involved in open market operations on an ongoing basis, and that's going to take that period of time. And as the underlying level of reserves rises due to our bill purchases, the need for repo will decline, and sometime around the middle of the year we'll reach that level of ample reserves, and from that point forward, the balance sheet will grow at trend demand for our liabilities. We'll continue to expand with the economy and with
Are you doing a review on your capital requirements for financial institutions that should be participating in the repo market?
Well, I think we've reviewed supervisory and regulatory practices that may be affecting the flow of liquidity. Our main focus, of course, is the federal funds market and our ability to transmit our policy decisions smoothly into the money markets through the federal funds rate. What happened in last September, early September, was that there was unusual tightness and volatility, and we attribute that to the fact that what appeared to be ample levels of liquidity didn't flow where they might have. And so we're really doing two things. One, we're raising the underlying level of liquidity by raising reserves to a level that's higher than we had thought we needed. And that process, as I mentioned, will take till the middle of the year.
So part of that is a supervisory assessment as well, to make sure that The policy is being driven in terms of the institutions.
That's right.
Okay.
And so we've been doing that since September.
So I raised this in my opening statement about China. Now, you've spoken publicly about your assessment, your thinking as you see what is happening with China's response to the coronavirus. We wish them well. We have high hopes that they're going to be able to tackle this crisis, this public health crisis they're facing. But walk me through your thinking in assessing the situation in China now, in terms of the economics, and that potential spillover effect.
So I'll just quickly start by saying again that we find the U.S. economy in a very good place, performing well. We see signs of global growth bottoming out. We see reduced trade policy uncertainty. Overall, the background, we see strong job creation, continued moderate growth, all of those things. All of this happens in the context of a good, strong U.S. economy. And into that picture comes the coronavirus. And so the question is, how do we think about that? Of course, first we observe the human tragedy, which is terrible to watch. But the question for us really is, what will be the effects on the U.S. economy? Will they be persistent? Will they be material? That's really the question. I think we know there will be effects on China through some part of the first half of the year, and China's close neighbors and major trading partners in Europe as well as Asia. And we know that there will be very likely be some effects on the United States. I think it's just too early to say. We have to resist the temptation to speculate on this. And so we'll be watching that carefully again. And the question we'll be asking is, will these be persistent effects that could lead to a material reassessment of the outlook?
So a question of length of time and whether or not this is a temporary disruption.
Yes.
Thank you.
The gentlewoman from New York, Ms. Velasquez, is recognized for 5 minutes.
Thank you, Chairwoman. Chairman Powell, I would like to follow up on Ms. Waters' question on CRA. What aspects of the proposed changes to the CRA do you find most troubling?
So, again, what I'd like to do, if I may, is not so much comment directly on the other proposal, but talk about how we are looking at this. And again, we think, and I will mention the areas in which we have differences.
Okay, I hear that. I hear you and I respect it. But I just would like to ask you, if the Fed is unable to reach an agreement with the OCC and the FDIC on a joint rule, do you expect the Fed to issue its own proposal?
We haven't made a decision on that yet. Right now, our focus has been on trying to get on the same page. We haven't been able to do that. Now our focus is going to be on learning from the process, and I think we'll learn a lot. I think
Are you meeting regularly with the OCC and FDIC on this issue?
So we did for a long time. We're not currently meeting with them on this.
So would you agree with Governor Brainer's comment that it's more important to get the rule right than to do it quickly?
Yes, I mean, I think that's been our approach and will continue to be.
Thank you. Chairman Powell, as you know, Representative Porter and I have been concerned by banks' growing reliance on cloud-based service providers for their data storage needs. Does the Fed have all the access authority it needs, or are there any contractual or legal limitations restricting the Fed's ability to obtain the data held by third parties that it needs to properly understand and manage this growing reliance?
So I think we do have the legal authority that we need. We are able to look into third-party service providers, and we're doing that more and more because of, as you mentioned, the prominence and size of these growing importance of these cloud service providers.
Thank you. I yield back.
The gentlewoman from Missouri, Ms. Wagner, is recognized for 5 minutes.
I thank the chairwoman, and thank you for being here, Chairman Powell. We're all very interested, since it just happened on January 29th, the spike, the repo spike. I know the ranking member mentioned it. I know you're in the middle of your review and such, but could this, I have a little more specific question, could this repo market turmoil be symptomatic of deeper difficulties for the financial system?
Really, it doesn't appear to be at all. Since we took the measures we took in early September, repo markets and money markets have been functioning very smoothly. There hasn't been a return to the volatility. They're functioning very normal, really, including over year end. So we haven't had any return to that. It's pretty clear that the measures that we took directly address the problem. Mm-hmm. When the medicine is working, you can really see, and it seems to be working well here.
And we had a confluence of things happening, I know at that time, with the quarterly federal taxes due, along with the Treasury auction of debt of upwards of, I think, around $78 billion, wasn't it?
Yes.
You think that was a function of perhaps this fluke, would you call it?
We knew all that, though. The thing is, we knew that, and what we had done was we'd asked banks to tell us what's your lowest comfortable level of reserves.
Right.
We got those numbers, we added them up, we put a buffer on top of it, and it still suggested that there was plenty of reserves in the system. But then this happened, and I think that makes us think, because we knew about those big payments.
Those were definitely on the horizon. And you're doing a review. I hope that you will find that there isn't anything symptomatic of some deeper difficulties, and we look forward to that. Turning the page, Chairman Powell, in December of last year, I asked Vice Chairman Quarles for an update on the status of updating the GSIB surcharge and plans for finalizing the stress capital buffer proposal, which I understand will require a re-proposal with the comment period. In January, Vice Chairman Quarles delivered a speech where he spoke about bringing, quote, reasonable transparency to several aspects of the Federal Reserve's supervisory and regulatory framework. Last week, the Fed released the CCAR stress test scenarios. To my knowledge, there has been no progress or update on the status of the stress capital buffer, apart from continued assertions by you and Vice Chair Quarles that aspects of the proposal will be incorporated in the 2020 CCARs. Given the acknowledgement by principals at the Fed of the importance of transparency, I guess I'm concerned about the lack of transparency in this process. When can we expect progress on this proposal that has, it has been in process now, I think, since April of 2018?
We do continue to expect and intend that the core of the stress capital buffer will be incorporated into the framework in time for the 2020 stress test. So we're moving along on that, and we're on track to do that.
You do feel on track to do that, then?
Yes.
All right. Committee Republicans have underlined the importance of cyber threats as a potential systematic risk. We have recently seen malware attacks undermine government infrastructure, and according to research last month by economists at the New York Fed, a simulated cyber attack on just one major U.S. bank could have spillover effects impacting 38% of the wholesale payments network. What can the U.S. do better, Chairman Powell, in order to prioritize these constant flow of cyber risks and strengthen the resilience of our financial sector?
I think we can keep doing what we are doing, which is to make this really a top, if not the top, supervisory priority, not just for the banks, but for the Fed and for institutions across the American landscape. We have very high expectations, particularly of the largest banks, on their ability to fend off cyber attacks. We're constantly meeting inside the government to make sure that our system is resilient and redundant and strong against cyber attacks. But there's never a feeling that you have gotten to a place of comfort on that. We just have to keep working, and it's staying in the minute, learning what the new attacks are, making sure that the banks are doing the basic housekeeping, and all of that is very much in train, and we'll just have to keep at it, I think, for a long time.
I thank you. My time's expired. Thank you so much for being here again, Chairman Powell, and I yield back.
The gentleman from California, Mr. Sherman, who is also the chair for the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
A couple of responses to what the ranking member had to say. Yeah, the stock market's way up. Wages are up a bit more than 1% in real terms after inflation. Wages at the bottom have risen, chiefly in those states where we raised the minimum wage. And when we have a Democratic majority in both houses, we will raise the minimum wage nationwide and deal effectively with those states that have not seen such an expansion of wages at the bottom. I've grown, not quite old, but I've spent many decades in this room. I've seen your predecessor's predecessor's predecessor. And every time they come in and the Republicans attack them for expansionary monetary policy, both traditional and newfangled, and now we have a new president, and all of a sudden they're pushing on the other side. All I'll say is that I've consistently, from the days of Mr. Greenspan, been pushing for somewhat lower interest rates and an expansionary policy, particularly quantitative easing, because you returned $55 billion to the Treasury last year, and that's, I know, not your purpose, but think of the kids that will get an education because we could fund aid to local education. Think of the medical research and the lives that will be saved because we were able to fund medical research. I don't think the $55 billion should be regarded as an irrelevancy or an embarrassment. And finally, as to the jobs growth we've seen recently, I do need to point out the jobs grew much faster in the last 3 years of the Obama administration than the first 3 years of the Trump administration. It is as if Trump inherited a plane, as he inherited so much else. The plane was on automatic pilot, and it was going in the right direction, and he hasn't managed to completely screw it up. We've got an issue that I think ought to be completely bipartisan, and that is LIBOR. It's going to hit us in a couple of years. Chairman Powell, should Congress simply give the Fed the right to prescribe backup rates when the debt instruments do not do so? Or should we explicitly adopt SOFR? Or what can we do and hopefully do this year and actually solve a problem 12 months in advance?
So on LIBOR, as you know, our process is ongoing, and we're really committed to having the banks ready by the end of next year to switch away from LIBOR in case it is no longer published. That date is
well, they need to know legally what to switch over to, and we want to avoid multi-billion-dollar lawsuits when somebody can say it should be this instead of that. They not only have to have the technology to make the switch, they have to know legally what they're supposed to do.
If we need a federal law change, we will let you know. I think
well,
right now
you've got less than 2 years. Have you figured out whether you need a federal law change, or?
I don't think we do need a federal law change right now.
Well, if you could get us an answer, because there are people who want to wait around until 2 or 3 months before things blow up and then come to Congress and say, now fix it. 2 years is actually too short a time, because we're impairing the economy today because you and I are talking about this, and there's this slight risk out there of litigation and uncertainty with regard to legacy LIBOR, and we ought to take that off. That's one of the things we can do to help the economy. So I hope that you would act within a month to let us know what you propose rather than wait till next year. Another area we've talked about before is the wire transfer system. We've seen $150 million lost to scams, and those scams arise chiefly because when you wire money, you do so to a number, but there's no payee identified. The British have gone to a confirmation of payee system. The International Standards Organization has prescribed changes that would require at least identification of payee. We don't. I know you have raised issues of state law. I've analyzed it. I can't see what would prevent the Fed from prescribing what the wire transfer system would be. And it looks like I'll have to ask you to get back promptly for the record on that question.
The witness is requested to provide an answer in writing for the record. The gentleman from Oklahoma, Mr. Lucas, is recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, during your testimony before the Joint Economic Committee last year, you were asked about what steps the Federal Reserve is taking to assess the impacts of climate change on our financial system. In your testimony, you made the distinction between the purely informative stress test for climate risk that the Bank of England does and what the U.S. stress testing regime under CCAR does, which is impact and inform capital requirements for capital distributions. My understanding is the Bank of England is conducting research and asking financial institutions to think through their portfolios and how they could be impacted, but they're not currently integrating those measures into capital requirements. Would you outline some of what the Fed is doing in the terms of research and engagement on global climate risk?
Sure. So I should begin by saying that climate risk is a very important, climate change is a very important issue that Congress has largely assigned to other agencies. It does play into our work, however, as it relates to the public's very reasonable expectation that we would make sure that the financial sector, the banks, the utilities that we supervise are resilient against the longer-term risks from climate change. So we're in very early days of understanding what all that means. And so there's work going on around the world at central banks to try to figure that out. You talked about the Bank of England stress tests. You know, those are not intended to inform current capital requirements, but more informed to understand what might be the effects on banks from climate change.
Are you planning on joining the network for greening the financial system?
We haven't made a decision about that. We've always attended their meetings. I mean, I guess my theory is when you join an organization like that, you're not necessarily, signing up for everything that everybody there believes. You can benefit from the work that's being done there, and we're kind of doing that now. We have not made a decision about membership.
Vice Chairman Quarles recently outlined changes that would increase supervision, transparency, and accountability. And I was encouraged by those comments, and we'll be following this closely, of course. One change the Vice Chairman outlined is that the Federal Reserve should restore supervisory observations, which will allow notice of a supervisory concern without it rising to the level of a matter requiring attention. Can you tell us what the timeline is that you see on those proposals to improve supervision?
Timeline is hard to say. I would just say what the Vice Chair did was he pointed to this tension that exists between very fundamental expectations of due process, transparency, and fairness around everything the government does, and should it be associated with that, but also with supervision, which by its nature is private and somewhat discretionary, non-public, and confidential, really. So he pointed out that tension and the need to shed more light on that and to ask whether there are places where supervision needs to incorporate more of that due process thinking. I think that's a very healthy thing to think about, and it's something we'll be working on.
In light of the coronavirus, Chairman, I can't help but think about, as a young man, as a boy, I spent a lot of time around my parents, my grandparents, I should say, and my great aunts and uncles. They were born just after the previous century. So their tales of firsthand experience in the pandemic of 1918 and 1919 were very graphic as it rolled through rural western Oklahoma. And the reason I bring this up is their description of that particular virus at that particular time in that particular rural society was that literally it brought everything to a stop for weeks in rural western Oklahoma. Now, my mother's family, my father's family were very fortunate. No one died from what was called the Spanish flu, but it brought society to a stop. The reason I ask that is, with 43,000 cases worldwide and the critical impact in China, could you describe for a moment how China and its neighboring countries are responding to the economic impact of coronavirus in general and from the perspective of your fellow central bankers in those countries?
I think they're really responding now to the outbreak and containing it. And the Chinese government has obviously taken very strong measures on that. You see businesses closing down in the affected areas. You see that sort of thing. In terms of the economy, as you asked, the People's Bank of China has done a number of things to support economic activity, and I think you can expect the Chinese government to do lots of things to support economic activity, and they've said that they're open to cushioning the economic effects. We're not seeing it, we're not able yet to estimate the size of the economic effects. There are many estimates out there, but I think you'll see governments acting in Asia, particularly in China, to offset those.
Thank you, Mr. Chairman. Yield back, Madam Chair.
The gentleman from New York, Mr. Meeks, who is also the chair for the Subcommittee on Consumer Protection and Financial Institutions, is recognized for 5 minutes.
Thank you, Madam Chair. Welcome, Mr. Chairman. Let me touch quick initially on asymmetrical growth. It's been discussed at length in my community and others that 40% of Americans don't have adequate savings for a $400 emergency. And similarly, 1 in 5 Americans skip essential health care or fail to pay important monthly bills due to the lack of funds. So finally, a large share of the population is also underbanked or unbanked. And we've talked about that a lot in the on the committee of which I chair, the subcommittee I chair. So my first question to you then is, why haven't circumstances improved for low and moderate income Americans more rapidly in the past few years, given the so-called, the state of the economy?
Well, the pattern was that at the beginning, it was more people who had just left the labor force perhaps made it right back in. What we really have seen, though, in the last 2 or 3 years has been wages moving up the most at the bottom end of the wage scale. So we do see, during this very long expansion, significant effects now in low and moderate income communities, and it's great to see. As I mentioned with our Fed Listens events, we've been hearing quite a lot about that. So that's very positive. More to your point, though, waiting for the 9th, 10th, and 11th year of an expansion isn't really a strategy. We do see those things now because the labor market is strong. But really, we need other programs to address the longer run needs of those communities, other than just the business cycle and monetary policy.
And so, also during this period of time, would you say that a number of us have been arguing, and finally we're moving toward a $15 an hour minimum wage for individuals on the bottom? Would you think that that has something to do with helping them also, the fact that many states have adopted a $15 or higher minimum wage than what had been put in place?
I will answer your question directly. Let me first say, though, that we of course don't take a position on the minimum wage. That's a classic trade-off that legislatures have to balance.
I understand.
So there's the research on exactly what is driving up wages at the lower end does suggest that there's a role there for the minimum wage increases. States that have had minimum wage increases have seen, there's a noticeably higher increase, but really it's much broader than that. And the bigger factor really just is very low unemployment and a strong labor market, high job creation. That's the main driver.
So the other concern that I have, because it also seems as though, as unemployment goes lower, et cetera, it's still, when you look at black unemployment, it still remains nearly double that of white unemployment. And it seems to stay that way whether the cycle is a down cycle or an up cycle. So are there any signs of how we close those gaps? I mean, because there's always these gaps that seems to happen between the African-American community and whites, where even though it's good economy, that gap stays the same.
There are persistent gaps, and they're very troubling, and they're not, in the long run, something that monetary policy can address. It really is up to other policies by governments, state and local governments, the federal government, and frankly businesses too, to do what they can to close that gap. What we have is an interest rate tool, and what we can do is support the goals you've given us, maximum employment and stable prices. We see positive effects from that, but over the longer run, it really needs broader policies of education and other things that would help with that issue.
Okay, let me ask, and I know Chairwoman Waters asked some questions on CRA. There were some questions that came up that maybe you can answer. The framework that was put forward by Governor Brainard not too long ago, is that the same framework of the Federal Reserve Board? Is it just, some are saying it's just her opinion and it's not that of the board? Is it, so maybe you can clear it up. Does the board see it similarly as Governor Brainard?
So we actually haven't taken a proposal to the board yet, but no, that represents the thinking of, that she's been working on this. I asked her to lead this effort for us. She was the head of that committee for some time. I'm very comfortable with the thinking that's in that speech, and support that set of ideas and that approach. But it's not at a place where we can say this is a proposal from the Fed, because we haven't taken it to the board yet.
Thank you.
The gentleman from Florida, Mr. Posey, is recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chairman, the world's experiencing dramatic growth in the space economy, and many are marveling, actually, at the expansion of civilian space launches. I represent the Kennedy Space Center, and obviously we're really excited about all that. Now, several estimates put the current level of global space economy at well over $400 billion a year, with a growth rate of 8% from 2018 to 2019. In December, the Bureau of Economic Analysis announced creation of a space economy satellite account, a new collaborative effort to measure the relative importance of the space sector on the U.S. economy, with a special emphasis on the growing commercial space segment. This effort will use input from industry experts and multiple government agencies, obviously. I recall over the years that the Atlanta Fed has applied expertise to report on the economy of the space district. First question, can you work with me to ensure that the Federal Reserve joins this multi-agency effort with an eye to avoiding financial bottlenecks and keeping this important space industry on path to a healthy growth rate?
First I'm hearing about it, I will surely, I'm happy to assure you that we'll take a close look at that, and if it's something that would be productive, would take part.
Great. Over the years, we've developed a rather expansive policy of Federal Reserve independence, and I believe in assuring the freedom of the Fed to act independently on a day-to-day basis to manage our economy and the critical payment system. I would not expect a member of Congress or other officer of government to insert himself or herself into a decision by the Federal Reserve Chair, the board, the Open Market Committee, or the Fed Monetary Policy Entity. Congress does not direct day-to-day monetary policy, and Congress also does not direct generals on battlefields, nor should we. However, the GAO routinely conducts policy audits of the defense policy and strategy, yet the GAO is restricted from conducting policy audits on the Federal Reserve. I'm challenged to understand how policy audits of critical national defense strategy is okay, but policy audits of the Fed are off limits. The defense industry is surely at least as sensitive as the monetary policy, and I'd like your thoughts on that.
Sure. So the GAO does do policy audits on the Fed constantly all over the place at the Fed, just with one exception, and that is our specific monetary policy function. Congress chose long ago to create one step of distance away from the GAO in order to underline our independence. I think that was a wise move. I think changing that would clearly be seen by the public as a diminution of our independence. We do look to this committee and to the equivalent committee on the Senate side for oversight on monetary policy in our system of government. Our road to oversight and transparency runs right through this committee and the Senate Banking Committee as well. So anyway, that's what I would tell you about the GAO.